All right, let's begin with the big story that came in this evening. U.S. GDP numbers were expected for the first quarter, and the economy in the United States has shrunk more than was previously expected. The second estimate of the Commerce Department shows that the U.S. economy had contracted at 1.5% annual pace. This is a slightly bigger contraction than the first estimate had suggested. Consensus estimates had seen the deceleration penciled in at 1.3%. There were some bright spots, though, in that data release. The second estimates show strong consumer spending, higher than what was previously thought, and robust business investment during the quarter. Another positive data point came in on the jobs front. The number of people making initial claims for jobless benefits fell to 210,000 from 218,000 the previous week. Analysts had expected 215,000. U.S. markets rose slightly. The Dow Jones up just a tad as Wall Street tries to rebound from a long string of weekly declines. Remember, the Dow has fallen for the last 8 weeks, while the S&P 500 and the Nasdaq are riding 7-week losing streaks. To get a better sense of what direction the U.S. economy is heading in, I'm joined now by Santosh Rao, Head of Research and Partner, Manhattan Venture Partners. Santosh, hi. Great to have you on the show this evening, India time. Your overview really on the numbers that have come in today, are they really out of range of your expectations?
I would say it's essentially in line. It's declining, but there are a number of other things. There's some good spots out there. The demand's still strong. There were other factors like the imports went up, the government spending went down. Went down rather. So all those things kind of impacted the growth factor on the growth side of the equation. But net, I think I would say it was essentially in line, and the market knew that. And then the jobless claims today was less. So I think there was a little bit of ray of hope out there, but you have to take the bigger picture. The underlying fundamentals, the demand side of the equation that the Fed is trying to tap down is still very strong. The headwinds are there, and inflation is very high. And then you have this global macro cross currents of the war going on, and the China maybe shut down, supply chain constraints coming down. So there are a lot of issues out there, a lot of headwinds out there. Too early to be optimistic yet. This is a small, I would say, a positive. But on the overall scheme of things, we still have a long way to go before we really get things under control. And the Fed is satisfied that they have controlled inflation, or they have a grip over inflation.
The markets seem to be cheering the numbers that have come in. The Dow Jones up 1.5% in morning trade. S&P 500 also a little over 1.5%, and the Nasdaq up 2%. Now the question over here, Mr. Rao, was not just what the Fed will do. The bigger question that seems to have been plaguing investors and economists around the world is the United States heading into a recession. Has that picture become a little clearer after these numbers?
Yeah, I think it just showed that recession is still a long way off. I mean, we're not there yet. I think it's going to take some time. If anything, I think the best estimates are that maybe later on next year, not this year. So I don't think recession is an issue at this point. Slowdown, yes, because the Fed really wants it to slow down. So I think that's where the focus is. How much slowdown? At what point do we get demand destruction where people pull back? Already we are seeing housing market slowing down, the mortgage rates going up. So there are all these factors kind of helping the Fed kind of tame the economy down a little bit, the intensity, the demand side of the equation. So we'll see how far that goes. I think recession is not an issue. The big problem, if I have to say, if I have to give my opinion, is stagflation. I mean, you don't want to go too aggressive, raise too high, and then really clamp down so hard that you pull the economy back into stagflation. So I think that's the big risk. We need to see if we can soft land this whole thing, and that's where the bet is right now. The market is trying to guess where the Fed is going to come, how strong, and how we land from here.
You know, Mr. Rao, you spoke in your first response about some bright spots that we've seen in the data, and we mentioned in our introduction that the jobs numbers were better than expected. But can you give us a little more detail on what those bright spots are, and do these trends look like they will sustain?
Yeah, I think the big thing, that the strong pillar holding up the economy was the consumer. Is the consumer still strong? And we still think it is. The consumer is strong. We saw Walmart and Target You saw all these retail outlets reporting numbers. Yes, it's softening, but it's still strong. The sales were record sales, everything's strong. What you're seeing is a shift towards the lower on the cheaper side of the market, or rather the lower price side of the market. There you're seeing some pressure. Consumers are shifting away from high price things and moving away, but you have to buy the staples. So you see the consumer is still there, it's still strong. He's kind of moving away from, he's adjusting his budget, and he or she is adjusting the budget right now. So I think that as long as the consumer is strong, and with 2 or 3 trillion by some estimates money out there in the consumer's hands, I think that side of the equation is going to stay strong. I think that is what will hold the economy together at this point. If the consumer breaks, then you have a serious problem. At this time, there is no risk of that, even though there is pressure on how they will be impacted.
All right, that's the silver lining there, that the consumer is still strong. Thank you so much, Santosh, for joining us on the show today. Now, moving